So today we will be starting with full disclosure concept. And in the previous classes, we have covered the other 8 concepts of accounting principles. So what is full disclosure concept? Full disclosure concept says that information provided by the financial statements are used by different groups of people. I told you that there are many users of accounting. We have internal users and we also have external users. So these group of people are like investors, lenders, suppliers, and others in taking various financial decisions. Why these users of accounting? Why these people need information? Because they have to take important financial decisions. For example, if suppose a company goes to a bank for loan, the bank will ask for the company's balance sheet. Why? Because the bank wants to know what is the financial position of the company. And the bank can ascertain the financial position of the company through seeing its balance sheet. Because balance sheet tells the financial health of any organization. So in the corporate form of organization, there is a distinction between those managing the affairs of the company and those owning it. So in reality, what happens now? The ones who manage the company and the ones who own the company, in reality, there are two different people. Like, for example, just take Reliance. Now, who is the owner of Reliance Group of Industries? Anil Ambani. So now, do you think that Anil Ambani manages the whole of the Reliance business? So he is the owner as well as other shareholders are also owner. Even I'm having Reliance shares. So to the amount of shares I'm having, even I'm the also owner of Reliance. Now, do you think that I go and manage Reliance business? I'm not even the employee of Reliance. So in reality, there is a difference between the one who owns the business, whose capital is invested in the business, and the one who manages the business. The CEOs, the MDs, and the various other managers who are managing the affairs of the company. But that is why financial statements are the only or the basic means of communicating the financial information to all interested parties. Here, interested parties are all internal and external users. So the report of that particular company is given by the financial statements, that how well the company is being run. It becomes all the more important that the financial statements makes full, fair, and adequate disclosure of all the information. So it's not just enough that the interested parties get the information, but the information should be full. It should be complete. It's like if the transactions are happening from April to March, 1st April to 31st March, you cannot just show the information from 1st April to 31st of January and miss out February and March. So in that case, it will not be full. Even if, let's suppose that on 25th of March, before closing the books, there was fire in the company's godown. And the company does not want to show this thing because if they show fire in the godown, then in the books of accounts, there will be some losses. And then their reputation might go down. So if they miss that information, which has happened on 25th of March, then it is not showing full, fair, and adequate disclosure. Okay, so the principle of full disclosure requires that all material and relevant facts concerning the financial performance of an enterprise must be fully and completely disclosed in the financial statements and their accompanying footnotes. What is footnotes? There are certain information in accounting which might not get converted immediately into monetary terms, but has a sufficient impact on the financial position of the firm. So it might not be able to record it in the money terms immediately, because money measurement concept says that everything related to a company should be recorded in monetary terms. So in this case, what happens? The company will write it in a statement form, like how when you write, like you make up, you do a calculation of a question and then you explain it down by writing it in theory. So similarly, in balance sheet, when you're not able to express in the terms of money, then below the balance sheet, you will be writing in the statement form. For example, of this fire only. that if the fire has taken place on 25th March and the godown was big, so it might not be possible for a company to calculate everything within 5 days and report it. So in that case, the company will just write as a footnote below the balance sheet that fire took place on such and such date, and it is estimated that this much amount of loss has happened. So this will be written as a footnote. This is a material information. Why it is material? Because when the fire took place, it's obvious that some stock must be lost, or there might be some damage to the property of the business. Got it? Here it is not converted in monetary terms, but then yes, there is a loss in the terms of finances. So it enables the users to make correct assessment about the profitability and financial soundness of the enterprise and help them to take informed decisions. To ensure proper disclosure of material accounting information, the Indian Companies Act 1956, now it's not 1956, it's Companies Act 2013. When we studied accounting, then it was Companies Act 1956, but now this 1956 has been revised and it has become Companies Act 2013. So it has provided a format for preparation of profit and loss account. And based on this format only, each and every company will have to make its accounting, company is going to draft its profit and loss and balance sheet. And the regulatory bodies like SEBI, they also mandate complete full disclosures. SEBI is Securities Exchange Board of India, where the companies list their shares. So it mandates complete disclosures to be made by the companies to give a true and fair view of profitability and state of affairs. So what happens if the company does not give true and fair view of the profitability? Then that means company is doing some window dressing. Window dressing means that they are falsely reporting some information. Okay. And then that leads to a scam. If it keeps on happening over a period of time and the company is hiding material information to get some benefit, then all these kind of misrepresentation becomes a scam. Okay, then the next one is consistency concept. What is consistency concept? You know what is consistency? In general English word, consistency means doing something in a same pattern, same way. That's consistency. Like for example, every day you study from 6 to 8 in a consistent manner. You're repeating the same pattern, everything. So similarly in accounting, whatever you are doing should be done in a consistent manner. Not that in 1 year you're calculating depreciation through written down value method. Next year you are calculating through straight line method. You know, now you might not be able to understand these words, but there are certain methods to be used for calculation of various items. So every year the company cannot change the method, because if the company changes the method, the finances changes, the numbers also changes. So let's read what does it say. The accounting information provided by companies' financial statements would be useful in drawing conclusions regarding the working of an enterprise only when it allows comparisons over a period of time. So, all these accounting records makes sense over a period of time where then you can compare current year's data with the previous year data so that you can get to know what is the difference in the performance of the company. Comparisons over a period of time, as well as with the working of other enterprises. Also with the working of other enterprises. Thus, both inter-firm and inter-period comparison. What is inter-firm? For example, Pepsi and Coca-Cola, comparing the balance sheets of each other because both are in the same type of business. This is called inter-firm comparison. And inter-period comparison is when Pepsi is doing the balance sheet analysis of current years 2023-24 with the previous year, which was 2022 to 23, and seeing the difference. For example, you seeing the report card of your standard 10th, comparing 10th and comparing the report card with standard 9 to see what was your difference of marks in various subjects. That is inter-period. But when you are comparing your report card with your friend's report card, then it becomes inter-firm. Got it? In simple words. So, yeah, it says that the firm should be able to do both inter-firm and inter-period comparisons. And this can be possible only when accounting policies and practices followed by the enterprises are uniform and are consistent over the period of time. Now, can you compare your report card with friends who have taken, till 10 anyways, everyone's subject is almost the same in CBSE. But what happens in 11? Some people take science, some people take commerce, and some people take arts. Now, will you go and compare your report card with someone who has taken science? You
Never,
can't.
ma'am.
Never, because it is two different field. So also now the way of calculation of marks. If in commerce also, if you just take about two different schools, school A follows different marks criteria and school B follows different marks criteria. For example, the type of assessment, whether some schools might have more of extracurricular activities and they might have marks for the other assessments. So like school B, they only keep marks for the academics. So can you now compare the marks of A and B school students, even if they're in same commerce field? You can't, because the type of assessment what A uses is much different from B. Other thing can be A might use grading system and B might use percentage of mark system. So you cannot calculate CGPA with grades with marks percentages. Okay, so the pattern should be uniform, and that is what accounting says. Accounting says that over a period of years, the method should be the same. The accounting procedures followed should be the same. Then only the comparison is possible. And international bodies of accounting, they do that only. They make it mandatory for all the firms, even at international level, to follow the same types of accounting policies and procedures. Later, we will be reading more about what is GAAP, generally accepted accounting principles, and what is IFRS. Okay. So all that thing we'll be reading it later. So that is what consistency says that. So to illustrate, if an investor matlab the one who buys the share of a company. So if the investor wants to know the financial performance of the enterprise in the current year as compared to that in the previous year, he may compare the company's this year's net profit with that in the last year. But if the accounting policy is adopted, say with depreciation, in the 2 years are different, like depreciation is one chapter, just now to know the name. So if suppose that's what I was telling, straight line method or written down value method. So if the depreciation policy was different in 2 different years, then the profit figures will not be comparable, because when you follow 2 different methods, your answer will be 2 different. And if your answers are 2 different, then your profits will be 2 different. So the profits will not be comparable, because the method adopted for the valuation of stock in the past 2 years is inconsistent. Okay, it is therefore important that the concept of consistency is followed in preparation of financial statements, so that the results of 2 accounting periods are comparable. Also, the comparison between the financial statements of 2 enterprises would be meaningful only if the same kind of accounting methods and policies are adopted in the preparation of financial statements. So this much only is needed. Just like if you write 4-5 lines about consistency, that is much, it's enough. You need not write this much big. You are not expected to write 2 to 3 paragraphs of answers.
Excuse me, ma'am.
Yeah.
Ma'am, can one company compare with another company?
Yes, why not? They can compare if they are in the same type of business. Example, Tata Motors can compare its balance sheet with Toyota. They both are in automobile car business. है ना? Dell can do this comparison.
Features are different.
Little bit of features difference will not matter. Same type of business, na? They can compare. Like Byju's can compare its business with an academy. Both the Vedantu or anything, because they all are in the same online learning space.
Ma'am, only the business matters.
Yeah, the business matters. Like for example, now Byju's cannot do comparison with Tata Motors, right? It's two different type of companies. Yeah.
Yes, ma'am.
Companies should be of similar kind. That is important.
Yes, ma'am.
Then we have conservatism concept. The concept of conservatism is also called prudence, which means that it provides guidance. Just give me a second. So conservatism concept. Well, what is conservative? What does the word conservative means? Conservative means traditional approach, or you can say one who does not want to take risk, or one who wants to. What is conservatism? The meaning of conservatism is uh, being, what to say, a little secure. So even accounting follows this principle of conservatism. It says that expect losses. Like when you give an exam and when you come home and calculate the marks, you always calculate little lesser than what the teacher will give you. Do you do that? Like, for example, if you have written the answer very well, out of 10, so you will not never do 10 out of 10 when you are calculating your marks. You might do 10 out of 8. Okay, teacher, if I've written it very well, then she will for sure give me 8. So you're playing safe. So similarly, in accounting also, we follow the principle of conservatism. It is also called prudence. And it provides guidance for recording transactions in the books of accounts on the basis of based on the policy of playing safe. The concept states that a conscious approach should be adopted in ascertaining income so that the profits of the enterprises are not overstated. Because in accounting, we do a lot of future anticipations. So it says that we should not anticipate profits. We should play safe. It does not mean that we should anticipate loss. It says that anticipate, but anticipate in a safe limit. If profits ascertained are more than the actual, it may lead to the distribution of dividend out of capital, which is not fair, and it will lead to reduction in capital of the enterprise. So this dividend part and all you leave, it's not much relevant to all of you right now in 11th standard. The concept of conservatism requires that the profit should not be recorded until realized. It says that until you earn the profits, don't write in the books of accounts. Okay. But all the losses, even which may have remote possibility, are to be provided in the books of accounts. Only these 3 lines are important. What does it say? 2 things. If the company is expecting or anticipating any profits, don't record until and unless it has happened. It's just like in life also now, your elders might have told you, until and unless something good happens, or when you do take some mannat, don't disclose it to people. Have you heard this thing? You're going to do something good, and until unless it has become real, don't tell it to people.
Yes, ma'am.
So that drishti might come, something like that. Same thing in accounting. Until unless even the profit is anticipated, don't record in the books of accounts, because when once it is recorded in the books of accounts, then all the internals and external users can see it. So don't record until and unless it has happened. But loss. But if the company is anticipating any loss, future losses, then they should provide for or record for. So if the company is expecting any loss in near future, they should be making provision for such losses. Okay. So that is there. So record, in other words, don't record profits, but record the losses. If there is any loss, record. Not like I will not read out the other parts to you right now because it will not make any sense. Then the next one is materiality concept. What is materiality concept? The concept of materiality requires that the accounting should focus on material facts. Material facts. Effort should not be wasted in recording and presenting facts which are immaterial in the determination of income. The question here arises that what is a material fact? What is a material fact? The materiality of a fact depends on its nature and the amount involved. Now, for example, if it's a stationery shop, okay, in stationery shops, there are lots of pens and small pins, and also those paper clips are there. So now, if the stationery shop who is doing a wholesale business and they have lost 2-3 paper clips, single paper clips from the boxes, Do you think it is a material fact and it has to be reported? It's not a material fact. Might not be recorded. It might not be reported. But if the whole paper clips carton box is missing, does that become material?
Yes, ma'am.
Yes. So now again here, the question is what is material, what is immaterial depends upon the business. Okay. Now, again, for a stationery shop, that paper carton box matters. For big companies like Tata Motors or Reliance Steel, if suppose guests are coming in their CEO office and they are served tea every day. So that serving of tea every day, like for example, 10 cups or 10 guests visit the CEO every day and 10 cups of tea is served. So that 10 cups of tea might not be material for a company like Reliance. But a tea stall owner, tea shop owner, for them the 10 cups of tea matter because they are in the business of selling tea, and each cup of tea matters as an amount of sale. But a company like Reliance or Tata Motors, they are not in the tea business. And for them, 10 cups of tea is actually an immaterial fact. Are you getting what is the concept of materiality and immateriality?
Ma'am, can ma'am tell what?
See, what does this say? The materiality of a fact depends upon the nature and the amount involved. Any fact would be considered as material if it is reasonably believed that the knowledge would influence the decision of informed user of the financial statements. For example, money spent on creation of additional capacity of a movie theater, okay? Money spent on creation of additional capacity of a theater would be a material fact, and it is going to increase the future earning capacity of the enterprise. So if suppose the company is in this PVR, you know, they are in PVRs, you can go and watch a movie in big malls. So if the PVR spends money on creation of a capacity, like they are increasing the size of the movie theater. So the money spent on such thing, it is a material fact that because in future, when this expenses will take place, then the revenue is going to increase because previously, if suppose 100 people were able to watch movie, with the increased capacity, maybe 150 people might be able to watch the movie in the same theater. So the sales will increase by 50 seats. So yes, it is a material fact. Similarly, information about any change in the method of depreciation. So leave this depreciation example. Now, for example, stock of pencils, erasers, scales are not shown as assets. So for a company, big company, when we show assets, stock of erasers, pencils, scales are not shown as assets because it is not a very material asset for big company. But for stationery companies, for stationery business, those who are into stationery business, for them, stocks of pencil, erasers, scales will be a matter of material fact because they are selling stock of pencil, scales, and rubbers, erasers. Are you getting it?
Yes.
Yeah. So what is material and what is not material also depends upon company to company. Anything. Now you might ask me, what is material, what is immaterial? How do we understand? Any fact, any information which relates to the earning capacity of the company or which affects the earning capacity of the company. If it affects the earning capacity of the company, then it becomes a material fact. I told you, a stationery shop, again, example of a stationery shop, if they lose one scale from the whole stock, then it is not a very big material fact, or one scale broke. They might not just show it in the statement. But if they lose the carton or like 10 sets of scales, then that becomes a material fact because then a part of stock is lost. Did you get it?
Yes, ma'am.
Okay, so you understood the concept of materiality?
Yes, ma'am.
The next is objectivity. What is objectivity? The concept of objectivity requires the accounting transactions should be recorded in an objective manner, free from the bias of accountants and others. Okay, it should be recorded in objective manner. How the transactions have happened, as same information should be recorded in the books, not listening to anyone else's advice and recording it. It should be free from the bias of accountants and others. This can be possible when each of the transactions is supported by verifiable documents or vouchers. For example, if the company, if the company's sales department, sales manager, he bought a cupboard for the company's office and the cupboard costed rupees 1 lakh rupees. So don't you think that when the cupboard is bought by the manager for the office purpose, for that 1 lakh, some bill will be generated? Yes. But if suppose the bill is lost, if the bill is lost and the manager tells for his, let's say, personal gain, oh, I bought the cupboard and the bill is lost, and then he's telling that the cupboard was bought for 5 lakh rupees. And in reality, the cupboard was bought for 1 lakh rupees. So he's giving false information to the accountant that it was bought for 5 lakh rupees to just keep 1 lakh, give 1 lakh to the company and give 4 lakh to himself. Now, here the principle of concept of objectivity is violated because he is violating the concept of objectivity. He is not recording or is not reporting the correct information. The accountant is getting biased by the information given by the sales manager. So it is told that each and every transaction should be supported by verifiable documents. So whatever is recorded in the books of accounts should be supported by documents or vouchers. For example, the transaction for the purchase of materials may be supported by cash receipt for the money paid. If the same is purchased on cash or copy of invoice and then delivery challan, if the same is purchased on credit, so whether it is purchased on cash or whether it is purchased on credit, there should be a document or information to verify such transactions. That is the concept of objectivity. And that is enough. You need not go in deep. Now tell me this, test your understanding part 2. Recognition of expenses. So what all, once let's revise what we have done, all the concepts. So now today we have finished. Matching concept. Today we have finished full disclosure, consistency, conservatism or prudence, materiality, and objectivity. So all these we have finished. Okay. And previously we have finished business entity, money measurement, going concern, accounting period, cost, duality or dual aspect, revenue recognition, matching principle, full disclosure principle, consistency, conservatism, materiality, and objectivity. Now let's do some questions. Now, recognition of expenses in the same period as associated with the revenue is called dash concept. When revenues and expenses of same period should be recorded in the same period, what is it called?
Ma'am, matching principle.
Matching concept.
Matching.
Yes. Very good, matching. Then the second one, the accounting concept that refers to the tendency of accountants to resolve uncertainty and doubt in favor of understanding assets and revenues and overstating liabilities is known as the accounting concept that refers to the tendency of accountants to resolve uncertainty and doubt in favor of understating assets and revenues and overstating liabilities is known as dash.
Ma'am, I think it is conservative principle.
Yes, it is known as conservatism. Very good. Then next is revenue is generally recognized at the point of sale. Revenue is generally recognized at the point of sale. Denotes the concept of dash. We have done one concept on revenue. Last to last class. Revenue is generally recognized at the point of sale. I have given the example of Flipkart. I have just placed an order on book.
Yes, ma'am. Ma'am,
Yeah.
I think it is revenue principle.
Yes, it is. It's called revenue recognition
Revenue.
concept or realization concept. Okay.
Yes, ma'am.
Then the next one is the dash concept requires that the same accounting method should be used from one accounting period to the next. Just now we did it. Consistency concept. Yes.
Yes.
Then the next one, the dash concept requires that the accounting transactions should be free from the bias of accountants and others. Just now we did. The accounting transaction should be free from the bias